You buy a $1 million umbrella policy. You pay the premium every year for 11 years. Then something happens, a claim is made against you, and the number is large. Your umbrella pays nothing, not a reduced amount, nothing. The policy was in force. The premium was paid. Nothing was canceled, and nobody did anything wrong. What happened is a distinction written into how this product works, and almost nobody buying it has been told about it. It has a name, and once you know it, the whole product makes sense in a way the brochure never manages. This is Policy Unpacked. Today, umbrella insurance and the two words that decide whether yours ever pays. This season has asked one question 7 ways, not whether you are covered, where the coverage stops and what is standing on the other side of that line. Today, that line has a technical name, and it is the only episode where the boundary is a number rather than a word. Before anything else, the scope. This covers personal umbrella liability policies in the United States. Every figure is illustrative, every scenario is invented, and terms vary by state, by carrier, and by the specific form you were issued. Nothing here is advice about your situation, because your policy, your state, and your assets decide your answer, and this video knows none of them. What it can do is explain the machinery, so you can read your own paperwork and see what you actually bought. And a note on tone. This is the product most often sold with a scare, and we are not going to do that. No worst-case story, no lost house, just the structure. Last time we followed a claim from the phone call to the check, and we ended at a wall. Your auto liability stops at a number. Your home liability stops at a number. When the loss is bigger than the number, the policy has said everything it is going to say. Umbrella insurance is the product sold for what happens past that wall. And the first thing to fix is the name, because umbrella is a genuinely misleading image. An umbrella suggests something spread over the top of you, covering everything underneath. That is not the shape of this product at all. The accurate image is a second story. It sits on top of a specific building. It has no foundation of its own, no door of its own, and no stairs that skip the ground floor. To get to the second story, you go through the first. Which means the interesting question about umbrella insurance is not how much it covers. It is what the first floor has to look like for the second one to be reachable at all. And there are 2 separate ways that floor can fail you. Here is the structure. You have a home policy with personal liability on it. You have an auto policy with bodily injury liability on it. Each has a limit. Those are your underlying policies. The umbrella sits above both. It has its own limit, commonly sold in millions. And between them sits the mechanism this entire episode is about. It is called the attachment point. It is the amount the underlying policy must pay before the umbrella pays anything at all. An example with round numbers. Your auto liability has a $1 million limit. Your umbrella is $5 million. The attachment point is $1 million. A covered claim of $800,000 is settled entirely by the auto policy. The umbrella is not involved. It does not contribute, it is not notified in any meaningful sense, and it does not care. A covered claim of $3 million works differently. The auto policy pays its full $1 million and stops. The umbrella then pays the remaining $2 million, drawing on its $5 million limit. So the umbrella is not a second opinion running alongside your policy. It is a layer stacked above it, and the layer below has to be completely used up before the one above wakes up. Those 2 words, used up, are doing enormous work. We are coming back to them. Now the condition, almost nobody reads. It is one short table in your policy, and it is the single page most likely to decide whether any of this works. We will come back to exactly where it lives because you are going to go and find it tonight. An umbrella insured does not simply sell you a layer. It requires you to keep the floor underneath it at a minimum height, and it writes that requirement into the contract. These are called underlying limits requirements, and they are the reason the product is affordable. The common market range looks roughly like this. On auto, bodily injury liability of around $250,000 per person and $500,000 per accident, with property damage around $100,000. On home, personal liability of around $300,000. Those numbers are a range, not a rule. Different insurers set different floors, some higher, and the only figures that bind you are the ones printed in your own policy. Same shape as file 3. 3 numbers on the auto policy, and the middle one is the per accident ceiling for injuries to other people. That middle number is the ceiling an umbrella is built to sit on, which means a decision you made about your auto policy years ago is quietly setting the height of a completely different contract. And that connection is where a very ordinary decision turns into an expensive one, because there is a completely reasonable thing people do to their auto policy every year that quietly disables the umbrella they are still paying for. Now the pricing, because it explains the design. A $1 million personal umbrella has commonly been quoted somewhere in the region of $250 to $550 a year, with national averages reported around $300 to $400 in early 2026. Those are illustrative figures. Yours depends on your state, your household, your driving record, and your carrier. And the range between states is wide. The same coverage that costs a few $100s in one state can cost close to 4 figures in another, driven by how expensive liability claims are in that state's courts. Because of the attachment point. The insurer is only exposed to claims that first exhaust several $100,000 of somebody else's coverage. Those are rare. The insurer is selling you the tail of the distribution, and the tail is thin. That is genuinely good value for the structure being purchased. It is also the exact reason the product has the failure mode we are about to describe. Let us run a normal one first, so the machinery is visible. Watch the order of operations here, not the numbers. In a moment, we are going to run the same scenario again with one detail changed, and the order is the only thing that will tell you why the outcomes differ so violently. Dana has auto liability at $250 over $500,000, home liability at $300,000, and a $1 million umbrella. All fictional, all illustrative. She is at fault in a serious multi-car accident. The injury claims against her, once settled, come to $700,000. Her auto policy pays to its per-accident ceiling of $500,000 and stops. That limit is now exhausted. The policy has done everything it promised. The umbrella attaches at that point and pays the remaining $200,000 from its $1 million. Notice what made that work. The auto policy covered the type of claim. It paid its maximum. And only then did the second story become reachable. 3 conditions, in that order, every time. Dana's total exposure was 0 beyond her deductibles. The product did exactly what it was sold to do, and it did it for a few $100s a year. And notice how little drama there was in that. No dispute, no argument about whether the umbrella applied. The auto insurer paid, hit its ceiling, and the file moved up 1 floor. That is what this product looks like when it works, and it is worth seeing once because the version that follows looks almost identical from the outside. Same policies, same premium, same paperwork on Dana's kitchen table. Now change one fact, and only one. Same Dana, same policies, same umbrella, but this time the claim against her arises out of something her underlying policy excludes. The auto insurer reviews it and denies the claim, not because the limit was too small, because the policy does not cover that type of loss at all. So how much does the auto policy pay? 0. The underlying policy paid nothing, so it was never exhausted. So the attachment point was never reached, so the umbrella never attached, and Dana's $5 million second story contributed exactly nothing to a claim she is fully exposed to. This is the distinction the whole episode has been walking toward, and it fits in 2 words: exhausted or denied. An exhausted policy has paid its maximum. The umbrella takes over. A denied policy has paid nothing, and there is nothing for the umbrella to sit on top of. And it goes one step further because of how these contracts are written. An umbrella generally adopts the terms, conditions, and exclusions of the policy beneath it. If the underlying policy excludes something, the umbrella typically excludes the same thing, which produces the sentence that should replace the brochure. A bigger limit does not fix an exclusion. It never has. Those are two different parts of the contract, and buying more of one does nothing about the other. This is the same shape as episode 5. A large number on the cover and a smaller mechanism underneath deciding what the check actually is. This season keeps arriving at that shape because it is how the whole product category is built. So what does a personal umbrella not cover? 4 categories come up repeatedly. 3 of them are ordinary, and the 4th one is the reason this episode cannot give you a clean answer, because it depends on which state you are standing in. First, intentional acts. If you set out to cause harm, there is no coverage. This is close to universal across liability insurance, and it is deliberate. Ensuring intentional harm would pay people to cause it. Second, your own injuries and your own property. Umbrella is liability coverage. It exists to pay what you owe other people. Your broken leg and your damaged car are the job of entirely different coverages. This one surprises people more than it should, because the word umbrella suggests general protection. It is not general. It is one specific promise, which is to stand between you and what a third party can collect from you. Third, business activities. A personal umbrella is a personal product. Losses connected to a business you run generally fall outside it, and that boundary catches more people every year as side businesses become normal. Fourth, and the one with a real complication, punitive damages. Those are the amounts a court can add to punish conduct rather than to compensate a loss, and they are generally not covered. But here, the caveat is not decoration. Whether punitive damages can be insured at all varies by state, and in some states, public policy prohibits insuring them regardless of what any contract says. So this is a genuine varies by state item, and it is not one a video can resolve for you. Some policies also carry more specific exclusions. Property rented to or occupied by you is one that appears in some forms. Exposures already subject to a sublimit is another. Now, hold all 4 of those against the second story image, and one more failure appears. It is not an exclusion. It is not in the fine print, and it is the one you can cause yourself without noticing. Your umbrella requires you to keep those underlying limits. Auto premiums rise. You go looking for savings. Lowering liability limits is one of the levers a quote comparison will happily pull for you, and the saving is real and immediate. But if you drop your auto liability below the floor your umbrella requires, you may have broken a condition of the umbrella. And in many households, the umbrella is with a different company than the auto policy, so no system anywhere notices and nobody phones you. You keep paying the umbrella premium. What that premium now buys is a question you would only get answered at a claim. That is not a trick played on anyone. It is 2 contracts that reference each other, held by 2 companies that do not talk to each other, and a household that reasonably assumed somebody was watching. So here is tonight's job. 6 lines, 3 documents, about 10 minutes. Open your auto declarations page. Find the bodily injury liability line. Write down both numbers per person and per accident. That is line 1 and line 2. On the same page, find property damage liability. Write down that number, line 3. Open your home or renter's declarations page. Find personal liability. Write down that number, line 4. Now open the umbrella policy itself and find the schedule of underlying insurance. It is usually a short table near the front, and it is the most important page in the document. It lists the minimum limits the umbrella requires you to keep on each policy beneath it. Line 5. Put the 2 sets side by side. Every number from your auto and home policies should be at or above the matching number in that schedule. And line 6. Somewhere in the umbrella policy is a list of exclusions. Read it once, slowly, not to memorize it, just to notice that it exists and that it applies on top of everything the policies underneath already exclude. If a number is below the schedule, that is a call to make this week to whichever company wrote the umbrella, not an emergency, a correction, and a cheap one. What this exercise will not tell you is whether you should own an umbrella at all, or how large it should be. That depends on what you have, what you earn, what you do, and the law of your state. Anyone who answers it from a video is guessing. The verdict on umbrella insurance is unusually clean, and it is neither of the two things it is usually sold as. It is not essential for everyone, and it is not a waste of money. It is a limit extension with 3 conditions attached. The loss must be a type your underlying policy covers. That policy must pay its maximum first, and you must have kept the floor at the height the contract requires. Meet those 3, and it is some of the least expensive protection in personal insurance. Miss any one of them, and the coverage you have been paying for is not there on a day when you very much need it to be. Exhausted or denied. If you remember 2 words from this episode, those are the 2. Exhausted means the policy underneath paid everything it promised, and the loss was still bigger. That is the case umbrella insurance was invented for, and in that case, it works. Denied means the policy underneath said this is not a thing we cover, and in that case, there is no ladder to the second floor because the second floor was only ever reachable through the first. And this is where the season's argument finishes assembling itself. 7 episodes, and everyone landed on the same structure. A definition decides whether disability benefits start. 3 numbers decide what an auto policy pays. A valuation method decides whether a check matches the damage. A sequence of steps decides when the money arrives. And an attachment point decides whether the layer above ever engages. Every one of those is a boundary, and none of them are in the marketing. There is one more, and it is the one that touches almost everybody in this country every single year. It is not a liability limit at all. It is a cost-sharing structure with 4 moving parts that interact in an order most people never see written down, and a ceiling that does not include the largest payment most households make. This is Policy Unpacked, how insurance actually works. No sales pitch.